All right, so the budget's obviously got a lot of detail. So in this video, we're going to go through and talk about family trust, discretionary trusts, because trusts have been something that have been specifically targeted in this budget. So keep in mind that obviously these are proposals at this point, so we really need to wait until the detail comes out. But conceptually, the government seems to be moving to this idea of taxing trusts as companies, because that's something that they've been that they've sort of stated as a sort of underlying policy position for some time. The interesting thing about the proposed changes, though, is not to treat them exactly as companies, because companies are a taxpayer that pays tax and retains those earnings, and then pays those earnings out later to shareholders via dividends, which then could be fully or partially franked, i.e. you get that tax credit with the dividend. What they're actually proposing with the changes to trusts is to have a specific 30% minimum amount of tax paid. So in other words, the trust will pay 30% tax. It will pay the distributions out to the beneficiaries with a non-refundable credit. So this is similar to the changes that Labor was looking to make back when Bill Shorten was running for election as Prime Minister for the non-refunding of franking credit. So this is akin to that. They're basically saying, hey, you can use the 30%, but if your marginal tax rate is greater than that, then you've got to pay extra. If it's lower than that, your average rate of tax is lower than that, then that credit's not refundable to you. Okay, so think of this as essentially making trusts taxed as companies, but with non-refundable franking credits is probably the easiest way to think about this change for trusts. Why are they doing it? Well, they're trying to stop the scenario where people generate income or generate earnings and distribute it to taxpayers that pay less than 30%. So essentially the $45,000 a year threshold where we jump to from the 16% threshold to the 30%. So that's really what they're trying to sort of target with this measure. Who's it really affect? Well, keep in mind that trusts, there's really two main types of trusts, is fixed trusts and discretionary trusts. Fixed trusts are being excluded because fixed trusts are fixed entitlement. In other words, everyone gets the distribution based on what their unit's entitled to them. So they're not targeting that. They're trying to target that discretionary scenario where trustees can decide to pay more, whether it's income or capital gains or whatever the nature of the distribution is, to taxpayers who would pay less tax than that. Distributing gains to someone who has losses to offset them, for example, some of those sorts of things. So they're trying to make sure that there's a minimum amount of tax collected from trusts. That's at least seems to be what is underlying the nature of this particular change. Why do they think that? Well, they think that trusts are used as primarily a tax planning vehicle. And the reason for that is probably because of the use of that has increased drastically over, say, the last 10 years or so. But that's really as a result of the effect of the change of the number of people being pushed into high marginal tax rates. So we've done a much more detailed video where we talk about that in a lot more detail for if you're really interested in understand the how and the why of that. Why has this been an explosion? But the short version is this is conflating a statistical category of people who are now doing something for a completely separate reason with real life people. So in reality, who's actually mostly affected by this are going to be those people who operate businesses, so active trusts, if you like, where their level of profitability is relatively constrained, somewhere around $100,000, $200,000 a year. At the moment, in many cases, they're going to be able to stream income relatively tax effectively. That's going to disappear. Everybody else really who uses trusts tends to either do so for a very limited period of time. We tend to move on to things like investment companies, etc. So yes, those of you who have discretionary trusts and are using them as vehicles, rest assured that even at this, if you're using them effectively at this point in time, that was only ever a step onto other vehicles. Nobody really keeps a discretionary trust as a major tax planning vehicle in the long term without incorporating investment companies and other structures into them. So if you have a discretionary trust, don't worry, we've got time to make the changes required if and when that's needed. If you're trading through a trust, that's a very different scenario. You really want to start looking at that ASAP because re-engineering that's going to be a much more sort of difficult scenario. Now, keep in mind that other types of trusts, so superannuation funds, we'll have a video more specifically on that, so check that video out, and one more specific on testimony trusts, because that's, again, a slightly different sort of scenario. But rest assured, if you have a family trust or are envisioning family trust, they are still going to be viable asset protection vehicles because that's really what they're for, despite what the government's sort of claiming. They're still going to be a very important part of asset protection potentially going forward. but their use as a tax planning vehicle was already relatively limited, to be honest, and probably going to be less so sort of going forward. It's probably going to reprioritize companies over trust is really the likely outcome. But the short version is you don't have to do anything straight away. There's time to make the changes required, and there's going to be concessions around rollover relief, etc. So we're not going to be forced to pay a whole bunch of tax with restructuring like you might normally do as a result of switching entities. So that's as far as trusts go with the budget.